Hello everyone, and welcome back to our series on financial ratios. In this video, we'll be focusing on two categories of ratios: liquidity ratios and efficiency ratios. These ratios can help investors and analysts to better understand a company's ability to meet its short-term obligations and how efficiently it is using its assets to generate revenue. Liquidity ratios. Liquidity ratios are used to measure a company's ability to meet its short-term obligations, such as paying off its current debts or covering its operating expenses. The two most commonly used liquidity ratios are the current ratio and the quick ratio. The current ratio is calculated by dividing a company's current assets by its current liabilities. This ratio shows how many times a company's current assets can cover its current liabilities. A ratio of 2 or higher is generally considered healthy. The quick ratio, also known as the acid test ratio, is calculated by dividing a company's current assets minus its inventory by its current liabilities. This ratio is similar to the current ratio, but excludes inventory since it may take time to sell and convert into cash. A ratio of 1 or higher is generally considered healthy. Efficiency ratios. Moving on to efficiency ratios, these ratios measure how effectively a company is using its assets to generate revenue. There are several types of efficiency ratios, but in this video, we'll focus on the asset turnover ratio and the inventory turnover ratio. The asset turnover ratio is calculated by dividing a company's total revenue by its total assets. This ratio shows how much revenue is generated for each dollar of assets a company owns. A higher ratio generally indicates that a company is using its assets more efficiently to generate revenue. The inventory turnover ratio is calculated by dividing a company's cost of goods sold by its average inventory. This ratio shows how many times a company's inventory is sold and restocked within a given period. A higher ratio generally indicates that a company is efficiently managing its inventory. Conclusion. By analyzing a company's liquidity and efficiency, investors and analysts can gain valuable insights into its short-term financial health and operational efficiency. If you like our videos, do like and subscribe our channel. Thanks for watching.